I would like to welcome you today to INET's webinar, Climate Risk and Response in a Post-Pandemic World. Ever since we began this series several months ago on the economics of the COVID pandemic, one of the most consistent questions we have gotten from our audience is that of the impact of the pandemic on climate change. So I'm very pleased that we can spend the next hour trying to delve deeper into exactly that question. In January 2020, right before our world shut down, the McKinsey Global Institute published a report, Climate Risk and Response, Physical Hazards and Socioeconomic Impacts. Our two speakers today, Dr. Krishnan and Dr. Woetzel, were responsible for putting together that report and are in a particularly good position to understand what the interaction of the pandemic is with climate change. The report put together climate models with economic models to understand the long-term risks, and I recommend reading it to get a sense of just how extreme the costs of climate change is going to be in terms of the lives and livelihoods of people all across the world. This is also exactly the kind of framework we need as we try to understand the interaction of these two crises. Dr. Mekala Krishnan is a senior fellow at the McKinsey Global Institute, McKinsey's business and economics research arm. Her research focuses on various topics related to inclusive growth and economic development, including climate risk, globalization, productivity growth in advanced economies, and women's role in labor markets. She is a member of a task force at the Hutchins Center on Fiscal and Monetary Policy at Brookings, focused on improving productivity measurement. She also serves on an advisory board for the Sibley School of Mechanical Engineering at Cornell University and is a board member of the Global Fund for Women, a leading public foundation dedicated to improving gender equality. Dr. Jonathan Woetzel is a director and senior partner at McKinsey Global Institute. Based in China since 1985, he has been instrumental in building McKinsey's China office. He also leads McKinsey's Cities Special Initiative and is responsible for convening McKinsey's work with city, regional, and national authorities in more than 40 geographies around the world. He's a co-chair of the not-for-profit think tank, the Urban China Initiative, that aims to develop and implement solutions to China's urbanization challenges. And he is the author of several books, including Capitalist China, Strategies for a Revolutionized Economy. Jonathan and Mekala, welcome.
Thank you, Pia. It's a pleasure to be here, and I enjoy the opportunity to have a conversation and a dialogue with INET members. So today, on behalf of MGI, I'll just kick us off. Mekala will do most of the presentation, and then I will come back and give a bit of a wrap up around the specific COVID-19 implications and relationships to our research. A few just words, very brief of intro. First of all, this is a McKinsey Global Institute presentation, which is MGI itself is a internal research organization of McKinsey and Company. It is funded entirely by the partners of McKinsey and Company and is not related or can be paid to do anything other than the funding but from the McKinsey partners themselves. So it's essentially our initiative and is unassociated with any other institution. Secondly, this work was, as Pia just mentioned, was launched at Davos in January 2020 and is largely based on facts and analysis conducted over the 2019 second half. So that is the fact base, and we are continuing to update this as we go forward. But to be clear, that's when the original work was done. Thirdly, that MGI and McKinsey is not a climate modeling institution, to be very clear. So we are presenting analyses and work that has been, where we worked in collaboration with climate modeling institutions such as Woetzel Research Institute, as well as ADB and many other World Resources Institute and many other institutions which are climate modelers. And so what we have done is to take their insights and their scientific analysis and translate that into an understanding of the risk and the impact of those scientific analyses on our economies, on our systems, and our natural biome. So that's just to be clear on sort of where McKinsey fits into the analytical spectrum of all of this. And then finally, Our intent in driving this research was very much to aim at this community of economists and the financial community, as we believe that ultimately an understanding of risk will allow us to make better decisions that in turn allow us to make better resource allocation decisions. And so that was why we launched this at Davos, sort of being a premier venue for the financial community. But in turn, we have seen a tremendous amount of interest and impact before, during, and after COVID amongst the financial and economic community. So I'm very much looking forward to hearing your reactions to this type of analysis, and so what questions as well does it prompt for you. So with that, let me turn to Mekala to begin the presentation, and I will come back towards the end. Over to you.
Great, thanks very much, Jonathan. Hopefully my screen is visible, Pia and Jonathan. Great, thank you. So as Jonathan said, we wanted to start by giving you all a little bit of a tour of what we mean when we say climate risk, and what are the types of risks we're describing, what are the socioeconomic impacts from these risks. So that will be the first part of the presentation, which I will cover, and then hand over to Jonathan to think about the implications of that risk, this form of risk, in our current COVID times and beyond. So let's start with understanding firstly the facts, right? So where are we standing today in terms of climate change? What climate science tells us is that the Earth has warmed. What this chart shows is the warming that different parts of the planet have experienced relative to pre-industrial times. That's often a benchmark that climate scientists use to think about temperature and warming. And what you see immediately from this chart is that warming has happened virtually in every part of the world. There are some areas that have slightly cooled, but for the most part, we've seen warming across the planet. But what you also see is that the degree of warming actually varies by location. There's some parts of the world that have warmed more, some parts of the world that have warmed less. And the reason that we wanted to start with this slide is emphasizing that this form of risk that we're talking about is a risk associated with the physical world. It's with the risk associated with our environment. It is therefore a form of risk that is outside of the economic, financial, and social systems that we live in, but in turn impact each of those systems. So it is linked with the physical world. It is also a form of risk that is associated with space. So different parts of the world have warmed differently. Different parts of the world will experience different forms of what we call climatic hazards, things like flooding or drought. And so it's important as we think about economic and financial analysis associated with this form of risk that we understand this notion of space and location. It's typically not something we consider when we think about financial modeling, when we think about economic modeling, but now needs increasingly a part of our thinking, understanding the interactions between the physical world and geography, and then economic and financial systems. The other characteristic of climate risk is the fact that it's all about probabilities, both means, understanding average events, but also tails, understanding the likelihood of extreme events. And we illustrate that on this slide by looking at one example for temperature in North America. So what the white line here shows is temperature observations across the Northern Hemisphere in the 1961 to 1980 period. What the blue line shows is more recently between 2011 and 2015, what those temperature observations look like. As you look at this slide, a few things are apparent. So firstly, the whole distribution has shifted to the right. So what that means is that on average, we're experiencing hotter days today in the Northern Hemisphere. But what you also see is in this blue shaded area that events that were extremely low probability events, what used to be a 0.2% probability event is now a 15% likelihood event. And so what used to be quote unquote tail events, which are typically described as events of low probability, now start to see increasingly higher probabilities. In this one example, that responds to a 75 times risk increase in the last 50 years. And that becomes important for a variety of systems that we take for granted in our day-to-day lives. For example, infrastructure. Infrastructure is typically designed to withstand 1% likelihood events, what are called typically 100-year events or 200-year events. But what now used to be a 100-year event is increasingly a 50-year event or a 25-year event. And so as we design our physical systems, they now need to be tolerant to different types of events, events of increasingly higher severity. It also matters, for example, for things like insurance that is, again, designed to withstand or to be resilient to a certain likelihood of event, a certain frequency of event. So each of our systems, we now need to think about in different ways and not just think about the mean event shifting, but also these tail events, low probability events that are becoming increasingly more likely. And COVID, by the way, is a great example of that, right? It's a low probability event, but one that is not a zero probability event. And that low probability event occurring had significant impacts, is having significant impacts for the world. And climate is a similar type of phenomenon where low probability events now not only could happen with higher frequency, but also could come with greater severity. So let's look at a few different examples of these quote unquote climate hazards that I described. I'm going to flip through a few pages here quickly so you can see the change over time. What these maps are showing is drought frequency in different parts of the world. And as I flip back and forth, what you see is that increasingly drought frequency is projected to increase in more and more parts of the world. One example being the Mediterranean, which used to be characterized by a Mediterranean climate. But fast forward between today, 2030 and 2050, if you focus on that region for a minute, we see more and more parts of the Mediterranean spending increasing time in drought. So that's one example of a type of event that we expect to increase in frequency and severity going forward. Another example might be hurricanes. So if you think about severe hurricanes, there are a few parts of the world that are exposed to severe hurricanes. One example being the southeastern part of the United States, another example being Southeast Asia. And what climate science tells us is that severe hurricanes are expected to become more likely as a result of climate change going forward. So both a chronic event like drought becoming more likely, also severe events like severe hurricanes becoming more likely. As we think about these forms of analyses, you'll see on the top left of many of these charts, this sticker that says based on RCP 8.5. What that implies is a specific carbon emissions pathway, CO2 emissions pathway. Climate science makes extensive use of different scenarios. And one of the things that climate science examines is different pathways for emissions going forward. Through our research, we've examined a specific pathway described as RCP 8.5. The reason we've picked this pathway is that this represents an unmitigated, unadapted world. So a world where we don't stop emitting CO2. And also we've chosen to start our analysis from the point of view of a world where we don't adapt. We don't do things like harden buildings or make infrastructure more resilient. We don't adapt to climate change. And so this to us represents what we call an inherent risk scenario. It's a risk scenario where if we don't take action to manage this risk, what the magnitude of outcomes might be. And so every result that you'll see is based on this inherent risk analysis to try and understand what's the scale of the problem that we need to solve and what is the scale of the measures that we need to think about to manage this risk. So let's understand what is at risk really. Climate scientists oftentimes talk about things in terms of flooding or in terms of hurricanes or in terms of drought. But what we wanted to do is take these climate hazards and translate that to real world systems that we all live with, interact with, rely on for our day-to-day lives. And what we find is that as climate hazards manifest, they impact different forms of socioeconomic systems that we rely on for our economic activity. They may impact human beings on the one hand and our ability to live outdoors, our ability to work effectively. They impact physical capital, both physical assets like buildings, but also infrastructure assets, things like bridges or railroads or roadways also are impacted as a result of a changing climate. And then finally, they impact the natural world, the natural environment that exists around us. And that has two forms of implications. On the one hand, it could impact food systems. So things that we rely on for where we grow crops, for example, could shift as a result of climate change or be affected as a result of climate change. But they also impact other forms of natural capital, things like glaciers or oceans. And so if you take a step back and think about it, on the one hand, this is very intuitive because climate hazard is a physical hazard. And so it impacts different forms of physical systems, whether it's human beings, physical capital, or natural capital. But looked at in another way, what these three represent in economic terms is factors of production in an economy. These are the things we need to produce economic activity. It's human beings and their ability to work, their productivity, physical capital, both the existence of that capital, but also the productivity of that capital, and then the same for natural capital. And what our analysis finds is that as climate hazards become more frequent or more severe, each of these three forms of factors of production, these five socioeconomic systems, are affected by a changing climate. So let's try and understand what is the nature of those effects and the potential magnitude of those effects. To do that, we followed what is quite typical within MGI, what we call a micro to macro approach. So we looked at a set of 9 different case studies that were intersections of different geographies, different sectors, different types of assets. And the goal with looking at these case studies was to try and understand really associated with a particular space. Remember, I said climate risk is spatial in nature. Associated with a specific type of impact across these 5 socioeconomic systems, what could the nature of the risk be? What could the potential magnitude of the risk be as we look forward in time? We looked at these 9 cases that 5 of which, or 6 of which are on the right, were in specific parts of the world. So for example, we asked the question of, will India get too hot to work? We asked the question of what would a Mediterranean basin look like without a Mediterranean climate, so on and so forth. We also looked at a few global case studies. So things like, will the world's breadbaskets become less reliable as the climate changes? What could be the implications for natural capital or infrastructure, so on and so forth. And as we did these 9 case studies, we looked at the learnings across these 9 case studies and then also rolled that up into overall implications for risk across the world. So let's start with that first. What are the overall implications from some of our research on risks across the world? As we looked at each of these 5 systems, what we found was that between now and 2030, we could expect to see significant impacts across all of these 5 systems in this RCP 8.5 unmitigated, unadapted world. So I'll give you a couple of examples. The first thing we looked at was livability and workability, human beings' ability to live outdoors, to work outdoors effectively. Today, nowhere on the planet is so hot or so humid that a healthy human being sitting in a shade might be affected or at risk of dying as a result of a heat wave. Typically, when we've experienced heat waves in different parts of the world, it's either been people directly exposed to not sitting in the shade, people engaged in physical activity, people that may already have other health conditions that are most at risk of fatalities from such heat waves. But what we find is that with the changing climate, more and more parts of the world could experience such lethal heat waves that even healthy human beings in the shade at rest may be at risk of dying. And running the numbers, what we found was that about 250 to 360 million people could live in areas with a 9% annual probability. Now, if you look at that 9% annual probability, that number might seem low, but then you start to aggregate that over time. In a decade, that essentially guarantees at least one form of lethal heat wave, at least one lethal heat wave of that magnitude. Another example might be when we think about capital stock. So we looked at capital stock that is things like buildings or factories that could be damaged as a result of river flooding. And what we find is that between now and 2030, about 2 times the amount of capital stock that is damaged today could be damaged from riverine flooding. Similarly, we find implications for food systems as well as natural capital. So each of the 5 systems we've described is affected in some way by physical climate risk. That was the numbers out to 2030. Fast forward to 2050, we continue to see buildup of risk. So each of the impacts that I showed on the previous slide is now higher when we fast forward to 2050, again in this unadapted, unmitigated world. That heat wave example that I had mentioned, now those numbers become 0.7 billion to 1.2 billion by 2050, and the average probability of such a heat wave occurring becomes 14%. The 2x number that I described for capital stock now becomes 4 times. So what these 2 analyses show us is firstly that every form of the system, every type of system that we're describing is affected. All the factors of production in an economy could be affected. It also tells us that this is an increasing form of risk. So without action to mitigate the risk, without action to adapt to manage the risk, we will see potentially increasing impacts as we move forward in time. So why is it that we're seeing impacts of the magnitude that we're seeing? We were actually quite surprised in many cases at how much risk was already in the system, how much the risk could increase. And the reason for that increase is what you see on this slide. Essentially, if you look at all of these systems, human beings and our ability to work and live, physical systems like buildings, natural systems, all of these systems have either been designed, for example, in the case of a building, or have evolved, for example, in the case of the human body, to be tolerant to specific climatic thresholds. Some of you may remember the European heat waves from a few years ago that essentially made it very, very difficult for people to live and to work in Europe. And that was because the buildings in the geographies that were impacted by these heat waves were not designed for those temperatures. Another simple example might be flooding. Buildings are typically designed to be tolerant to certain levels of flood. And as levels of flood increase, those tolerance bands, those design parameters of all of these systems could start to get breached, so that impacts could be significant, impacts could be nonlinear. So let's look at an example of that with food systems on this slide. So this is showing yields of a particular crop, which is maize or corn, and the reproductive growth rate of that crop is a function of air temperature. What you see is that up to about 20 degrees Celsius, yields of this crop increase. And then post 20 degrees Celsius, you start to see a dramatic fall in the yields of this crop. So this is an example of a specific design parameter for this crop. We grow this crop in regions of the world that are optimized for this climate. But now as the climate starts to shift, we could see dramatic falls in yields. Similar example on the right, when you think about a building, it's designed for a certain level of flooding. But once flood depths start to cross that, you could start to see not just increase in damages, but very non-linear, significant increases in damages beyond certain flood depths. And so as we think about all of the systems around us, whether it's physical systems, which are the three examples on this slide, but also economic and financial systems, things like insurance, things like mortgage lending, all of these systems have implicit in it the assumption that the climate will be stable, that the future will look like the past. And now we need to start to question these assumptions in a changing climate and start to interrogate the potential impacts that could happen across these systems as the climate changes. So I want to end by giving you a quick tour of a few different case examples of the 9 that I had described, so to start to give you a flavor of the types of impacts that we could experience in different parts of the world. So the first example here is looking at livability and workability in India. So as I said, the question we asked was, will India get too hot to work? And what we examined here was the impact of heat and humidity on people in India. The first thing we looked at is this panel on the top, which is showing how many working hours could be lost as a result of rising heat and humidity levels. As heat and humidity levels rise, the human body's ability to work outdoors starts to get affected. We tire more easily, work less productively, may need to take more breaks. And so what that means is that the amount of hours that one could viably work outdoors starts to get affected. And if you think about India, India is a country where about 50% of GDP, 75% of employment relies in some way on outdoor work, whether that's sectors like construction or agriculture. And so you put these two things together, a climate which is becoming increasingly hot and humid, an economy that relies significantly on outdoor work, and you start to see that just with this one climate hazard and this one type of effect, we're not talking about multitude of climate hazards, just a single climate hazard impacting India, you could start to see significant impacts on GDP. Running the numbers, what we found was that by 2030, about 2.5 to 4.5% of GDP in India could be at risk as a result of rising heat and humidity levels. Now that is a chronic effect, overall increases in heat and humidity. What we could also start to see is these acute events, these lethal heat waves that I was describing earlier. And what we find is that certainly parts of the subcontinent as a whole, these numbers are specifically for India, but this phenomenon is true for the subcontinent as a whole. In India, for example, we start to see increasing likelihoods of these annual heat waves such that by 2050, 310 to 480 million people could live in regions with a 14% annual likelihood of a lethal heat wave. Now, obviously, such events as with COVID have significant human impacts, significant impacts on our societal fabric, on our daily lives. What we haven't done is then factor in the economic implications, the economic knock-on effects of such phenomenon, right? If events like this manifest, the implications for economic activity in India is almost impossible to start to fathom. And we're seeing that happen with events like COVID. You know, there was initially the health effect, which was the pandemic and its implications, but that has then cascaded into a variety of effects on our economic, financial, and social systems. And climate is a similar event, where similar type of risk, where the physical can very quickly start to translate into the economic and the social. It's important to understand this form of risk, which is not one that economic and financial systems today are geared to understand and quantify. As another example, we looked at food systems. So food systems, as well as supply chains more broadly, have been designed to optimize for efficiency versus resiliency. We've done things like have just-in-time production. We have minimized inventory levels across supply chains. In food systems, we've essentially optimized our food production so that a few parts of the world that have optimal climates are responsible for most of our grain production. About 60% of global grain production comes from 5 regional breadbaskets. And about half of our calorific intake comes from four grains: rice, wheat, corn, and soy. What that does is it's created a very efficient system. It's these regions that are very optimized for these specific crops. But when we throw in climate risk as an added variable into this equation, what that reveals is a potential vulnerability. And that vulnerability is in the form of potential yield declines. We examined, as the climate changes, what is the likelihood of a global grain yield decline as the climate shifts, as conditions become more hot, more humid, more dry. What could happen to yields of these 4 very important crops in these 5 different global breadbaskets? And what we find on this chart, that this chart shows, is that the likelihood of that yield decline increases over time. So we examine the likelihood of a 5% yield decline, a 10% yield decline, a 15% yield decline. And what you see is that today, a value, for example, with a 15% yield decline might be 1%. Fast forward to 2030, it's 2%. Fast forward to 2050, it's 4%. And again, those numbers might be small, but what that's showing is the likelihood of such failures once in a year. If you start to compound that over a 10-year period, what's the likelihood that this failure occurs at least once in a 10-year period? And the numbers start to become very large. In a 10-year period, the likelihood of a 15% or more yield decline by 2050 is 34%. There's a 1/3 chance that we experience in a year, in a decade, a yield decline of this magnitude. And so it's important to understand that this factor that has made our systems efficient today, this optimized production across breadbaskets, also reveals a vulnerability that we now need to manage in the case of a change, due to a change in climate. Let's look at another example, which is real estate in Florida. So oftentimes when we think about climate events, we think about damages that they could cause to real estate, physical damage to buildings. I mean, that's the image that often we have as a result of a hurricane. But what we find is that there are other effects that climate change could have that could happen in advance of a damage or an event actually occurring. And we examined that with real estate in Florida. So if you think about a homeowner buying a property, as awareness of climate change starts to increase, homeowners may start to price expectations of future climate change into their buying decisions today. What climate change can, what financial systems, what transactions of this kind can do is pull forward future risks so that we start to see price devaluations on assets, in this case, real estate, in advance of events actually occurring. And we've done one analysis for Florida where we looked at how much devaluation already exists today by comparing homes exposed to climate risk, homes exposed to tidal flooding, comparing that to homes that are not exposed to this form of flooding. And what we find is that today already we have $5 billion of devaluation in the Florida real estate market as a result of that. And you fast forward to 2050, as more and more parts of Florida start to be exposed to tidal flooding, we could expect to see $30 to $80 billion of devaluation by that time. For impacted homes, that's about 15 to 35% the value of those homes. And this in many ways is a conservative estimate. It's based on trends we've already seen today. You could imagine looking forward that people more aggressively start to price this into their buying decisions. You could imagine more aggressive pricing in if key infrastructure starts to get affected, things like schools get flooded, things like water or sewage systems are affected. You could start to see more devaluation if things like mortgage lending becomes more challenging in the state, so on and so forth. But the key point of this analysis being it's not just damages and productivity that is important to think about when you look at climate risk. It's also important to think about pricing, asset valuations that could happen well in advance of a climate event actually occurring. We're already seeing some of this in Florida real estate today, and the extent to which we see this going forward could increase. And then finally, I want to end with an example on infrastructure. So one of the things we looked at was how a developing city like Ho Chi Minh could be affected as a result of flooding. Now, Ho Chi Minh is a city that already experiences flooding today, but the degree of flooding it experiences is not all that much. It's also not putting that many infrastructure assets at risk today. So what this chart shows in the red is the flood depth in different parts of the city. And then there's various gray circles that you see that indicate key infrastructure assets. I'm going to quickly flip ahead to the next chart. This is fast forward to 2050. What you see is that more and more parts of the city are now expected to be flooded. What you also start to see is that with the planned development of the city, more and more we have infrastructure assets across the city that could start to get exposed to flooding. And then I fast forward even further to a 180 centimeter flood. This is an event that one might expect in the 2100 timeframe. We just want to put it out there so you see very far ahead as well. But again, more and more parts of the city exposed to this form of flooding. So what this does is it creates risk for Ho Chi Minh for two different reasons. First is the fact that more parts of the city are exposed, and when they're exposed to floods of greater depth. But it also indicates that where we're laying down assets, particularly long duration assets like infrastructure for the future, needs to be carefully thought through. What our calculations show is that between now and 2050, Ho Chi Minh could experience about 2 times an increase in flooded area, about 2 times an increase in flood depth. But the damage that infrastructure assets could experience, that economic activity that relies on that infrastructure could experience, could grow as much as 10 to 20 times. And so not only are we experiencing increased risk because of increased hazard, we're also experiencing increased risk because of increased exposure to the hazard, because we're imagining putting down assets and infrastructure in harm's way. And so it becomes important as we think about forward-looking solutions to be thoughtful, not just about how resilient we make infrastructure assets, how hardened they are, but also be thoughtful about where we choose to locate such assets. And so with that, let me hand over to Jonathan to talk about what this means for climate risk in a post-pandemic world.
Great, thank you, Mekala. So the implications when we presented this were presented on the next page. Is that we think we are in the decisive decade, where on the one hand, we are locked into a number of things. As Mekala noted, that the scenarios we've developed were driven by an RCP 8.5 context, essentially the full inherent risk of increases in emissions with limited mitigation and limited adaptation for that matter. And of course, we do have a choice about that. There is some ability to change that pathway based on climate science telling us reducing emissions to net zero to achieve a different pathway, a 1.5 or a 2 degree pathway. And this is the decade where that happens, that there is some, if actions don't happen, we will be in the world of the high emissions world. And if they do happen, we might have a delay or an avoidance of those consequences. Either way, though, we will see some consequences. And at least in the short term, in the decade of the 2020s, we will be seeing the impact of this physical climate risk on our systems. And so we should get prepared for it. So that was our message back in January 2020. And then this happened on the next page, which is, as you'll see, COVID. So here we are today, or here we are August the 7th, 2020. And the world is right up there at, I forget how many millions of cases and hundreds of thousands of deaths. And clearly we don't know where this is going. I mean, some areas we have lower trajectories and we're declining. Some areas we have rising. So this uncertainty, was clearly something that we did not have. So the question in our research, and so as the question is then, as Pia was stating, so what does that agenda that we just laid out, how is it affected by this, and how should we change our thinking about climate risk, if at all? We would make the case on the next page that essentially that there is a common way of thinking about what we'll call physical risk. And that both climate effects and pandemic risks share a profile. So we've mentioned already a number of these aspects, and I'll just go through it and saying that when we talk about climate risk, we essentially say it has 7 characteristics as we've identified. It's increasing, that we're going to see between now and 2050 an increase of between 2 and 20 times in all cases, in our cases of leading edge climate change. So it's all things considered, it is increasing. We think that's also true for what we'll call pandemics. There are more pandemics now than there were before. So just the sheer number of pandemics is increasing. Secondly, spatial, that it is climate change, physical climate risk eventuates to a person in a place at a time. And that is also, of course, true for the pandemic, as we have seen, that we have a very great heterogeneity of impacts on locations around the world. 3, that climate risk is non-stationary. As we said, some of this is locked in, but in some other case, and so the risk is rising. Some of it isn't, and we have choices about that. In this case, equally, we'd argue that pandemics are non-stationary in the sheer fact that they are unpredictable, and our actions make a big difference to whether and how much we will have, even in the course of this pandemic, in terms of the risk it associates. Fourthly, they are non-linear, that it's clear that when climate risk eventuates, if it breaks a threshold of a certain temperature, of a certain level of depth of flooding, then systems break on top of that. And of course, we've certainly seen that in the case of the pandemic, the healthcare systems in that case. It is systemic, that we have climate risk affects the thing that it affects, but it also affects the thing that depends on the thing it affects, notably the economic activity and the communities about them. And again, we have certainly seen that to be the case for pandemics. 6th, climate risk is regressive. And I saw this was a question in the Q&A, and that there's no question that we think that the more vulnerable and the less well-off will see greater risk inherently, and will also have greater vulnerabilities. So that's a function not only of how dependent they are on the natural environment, but also of the resources they have available. Similarly, we've observed that the pandemic is highly regressive. Across all of our societies, the less well-off, the more vulnerable are experiencing its impacts disproportionately. And then finally, we would note that climate risk is underprepared, that given the rate of increase that we noted on the left-hand side, the level of investment, whether we're talking in insurance or resilience or behavior, all will have to be much greater to avoid much greater impacts. And of course, that is true for climate as well, for the pandemics as well. So given that these risks seem to share a common profile, you might argue there's a common approach to addressing them. And that's on the next page, that the approach we suggest is, first of all, to recognize that risk, to embed that physical risk into our decision-making, to capture the underlying trends and translate those into measures of impact. Secondly, to adapt to the hazards that we know, that we are now recognizing. And those are both, as I said, climate and pandemic hazards. And finally, we need to address the underlying factors to mitigate, to reduce the future risk. But those 3 elements are the core of an effective response to physical risk. So I'll talk about each one quite in turn. So for physical risk, there are a lot of things that most organizations need to do better, starting with the basics of measuring that risk and setting up an infrastructure to oversee it, to create governance and oversight and policies for that risk, and importantly, of course, to gather the data that they need to come to a meaningful answer. We've all experienced a lot of this in our organizations over the last 12 months, or 9 months for COVID. We're going to see more, and we think that this discipline is also going to be extended to climate. As I said, in many ways, we launched at Davos in order to enable this conversation to start, to integrate this risk into our decision-making. And I can say that we have seen more action and more movement in the last 12 months on the enablement of climate risk assessment than we have seen in the last 12 years. So we do think there is a lot more going on, both from governments, from the commercial sector, from academic institutions, to create this physical risk awareness in all of our decision-making. So that leads us to the next big topic of what do you do about that? So when we think about the adaptation agenda to the existing hazard, we would divide it into these three areas. There's the physical adaptation, the thing that we need to do to make ourselves safe today against the hazard that's coming at us today. There's the financial adaptation, which is essentially who is going to pay for that? And how do we avoid a mismatch? Sometimes we talk about the infrastructure paradox. We have hundreds of billions or trillions of dollars of long-term investable funds and hundreds of billions and trillions of dollars of long-term investable need, but never the twain shall meet. We need to avoid that happening in the case of these hazards. That mobilizing finance to fund adaptation, rethinking insurance to protect the most vulnerable, these are necessary to avoid essentially what is market or agency failure. And then finally, we will need to adapt our behavior. There's clearly some changes that can and should be made at the individual and the community level to recognize, again, that risk, whether it's preventive or reactive, or even in some cases, the issue of where, in fact, we will live may be required. Those are, as we said, spatial issues, and we will find spatially different responses for them. But a common theme is that we are not, that the stability of our physical environment was an illusion, that we are living in a highly volatile and increasingly volatile world. That puts a premium on the capacity to adapt. I'm going to say two things because it came up in the chat. I wanted to mention this adaptation, as well as any other actions, must reflect the regressive nature of the risk. So on the next page, we show that essentially for climate, it's clear that there will be greater risks for those countries which have lower incomes. Here it's showing, as Mekala mentioned, the impact of the outdoor working hours and translates directly into GDP. And so there is clearly a relationship here between lower GDP per capita, higher annual share of effective working hours, as a result, a regressive relationship between physical climate risk and income. So that's for climate. And on the next page, we can talk about the pandemic. And just to document, of course, we've seen in many communities, and here we highlight the Black American community in the United States, that experiencing a disproportionate effect of pandemics due to, in many, as commentators would say, access to healthcare, increased prevalence of comorbidities, inability to physical distance due to the crowding, all of which would provide, again, an example that whatever we do to adapt must reflect that regressive impact, as well as the potentially regressive cost of the adaptation itself. So that's the second big agenda item. And then the third item is mitigation. Now, clearly, this was not the mitigation report. McKinsey has done a 1.5 degree outlook, which I am drawing these numbers from. This is our scenario analysis for what it will take to address that 1.5 degree challenge. And it would require substantial changes to the structure of our economy, from the demand side to the supply side, to carbon management as an industry, finally to agriculture and methane emissions. But a comprehensive effort which would span essentially the entire economy, whether it's upstream or downstream. So electrifying road transport, deploying renewables, changing land use, changing agriculture, a lot of work. So how does COVID affect all of that? Well, I think it raises 5 questions, which we address on the next page. Essentially, the first question is, that's a lot of investment. Will we have the money? What would you have to believe that COVID will result in? Will it mean that we simply can't control the pandemic, which leads us to a lower growth horizon and a limited ability to invest? Or in fact, will our economies survive? Mitigation measures and required investments are possible, let alone likely. So there's a question. The second question is, how we respond to the COVID pandemic support mitigation? So on the one hand, you could believe that pandemic adaptation is inconsistent with a low carbon path, that we will de-urbanize and as a result increase our spending on the required standard of living that we expect to have in these less efficient communities. On the other hand, we could say reduced mobility, in fact, will be a good thing. There are some behaviors that will be changed and these will be sticky. We will see. Thirdly, will governments learn, if you will, and prioritize risk and resilience to a greater level and incorporate a higher level of mitigation and adaptation in spending plans? Or will immediate health and economic concerns take precedence? Fourth, will mitigation then be viewed as an economic priority? Assuming that risk and resilience is now in fashion, will we invest to mitigate as part of that? Or will we cement carbon-intensive structures in our societies and our economies? And finally, will mitigation itself be too expensive? And that something has changed with COVID that changes the equation for investing in mitigation, notably the low oil price environment and how we think about that. Those are questions. We would, posit that, in general, I won't say where we come, there's a presentation that raises quite more questions than it does answers, but our implication was that we were on the right-hand side of this, that we believe that these things are possible, that the response to COVID does allow us to think through an accelerated transition. But I think we will need to have clear and forthright responses from the whole economic community in order to be able to go forward with this in a consistent way. So lastly, there are some things that we must do. And so on the next page, we sort of say, essentially, these are the things that no matter what you believed about the previous conversations, the lessons of COVID, the importance of resilience thinking for systemic risk does raise to us the opportunity, if not the requirement, to make economic and environmental resiliency core to our planning. And that would include a number of steps for government to build that capability, to model and understand the economics, to incorporate resilience in the economic recovery, and to reconsider those subsidy regimes that accelerate climate change, recognizing their impacts on equity. For companies, again, having the capability to discover vulnerabilities against a much broader set of scenarios than they would have had before, to invest to make their operations more resilient and sustainable, and to prioritize those economically marginal assets that are carbon intensive, their retirement would be an agenda. And finally, for individuals to raise their awareness around these broader set of impacts and shift their mindsets and behaviors towards more sustainable models, we would think that this is an outcome of COVID-19. So that's our presentation. I hope it's been helpful. I know there are now 11 questions, so we can take more. We would encourage people to visit the site to read the full report, and of course to get in touch with either of myself or Mekala or any other folks at McKinsey as well. So.
Jonathan and Mekala, thank you so much. That actually was very informative and really quite comprehensive in terms of the range of issues that you folks have raised here. We, as you point out, have a number of questions that have come in. If I could just start with a question. One of the things you point out is that the impacts are going to be considerably greater on developing countries. And we're going to run into this issue once again of incentive structures. So the question I have is, how do we think about global governance in this case? And we have been looking in this country at something like a Green New Deal, there is a question of whether or not it even will work within just the US, but then how do we think about incentives for governments across the globe to be able to coordinate their response to something like this and take on their fair share of responsibilities?
Well, I could refer back to the conversation that we had at Davos, which I think was relevant, and particularly the role that Kristalina Georgieva played from the IMF perspective. And she was sort of essentially confronted by a colleague from Pakistan who noted that this was a great initiative. However, coal-fired power was much cheaper than solar installations in his economic calculus. And so was there something that the global community could do about that? And I think at that point, the idea that came up in the conversation was essentially a MEGA for climate. That the Multilateral Insurance Guarantee Agency, which essentially is there to support investments by providing a level of insurance, could be potentially extended to this issue of climate commitments. In the context that the carbon price that is needed to justify that mitigation is significantly higher than what it is today. So we all might have views of what it should be, but it's got to be a lot higher. So on the belief that we will get there, and we will create insurance, we will create standards and mechanisms to meet those standards that imply a much higher carbon price. But what about the investments for today? An insurance agency essentially would be the model. We could call that, financial adaptation, or a financial mechanism for mitigation. But that model would then have to be bought into by the global investment community, which would include governments, multilaterals, and the private sector. I think we're starting to see moves towards that model as people understand and can invest against that risk. I mean, if you are the mayor of Ho Chi Minh City and you are looking at or more appropriately, the party secretary, and you're looking at the 2100 outlook, you sort of recognize that there is a very substantial investment challenge ahead of us, and that having a source of funding is going to be for the studies and for the investments that will be needed to create more resilience is absolutely something that you will be going to market for. I mean, that will create a demand for this, as an example. So.
Very helpful, thank you.
Maybe just to add one point to that, I think just as we think about the climate transition, a lot of the conversation, maybe rightly so to date, has focused on comparing technology costs of say coal versus solar or coal versus wind, etc. Right? And I think what we're finding now is with technological development, from a cost standpoint, many of these technologies are cost competitive. I think the question becomes more, as Jonathan was saying, they require an upfront CapEx investment for a long-term OpEx benefit. So the mechanics of how you finance may now need to start looking different. I think there are issues related to how do you scale and build the capabilities to deploy technologies. I think thirdly, there's the question of what do you do to sectors that need to now start to ramp down if you need to think about mitigation, right? Whether that's coal, oil, etc. So I think the good news is that the debate is now starting to shift from our technology is viable to the nuts and bolts of how do you implement them successfully. And so as we think about global governance, global structures, it's important that the conversation becomes one of how do you finance, how do you protect the quote unquote losers, right? The people that lose their jobs or lose employment or where sectors wind down. Which might need different mechanisms for financing and different metrics, different standards. But a lot of the global conversation, I think, is shifting there, which is the good news.
Yeah, thank you. So we have a question here from Doug Carmichael asking about migration. He says, under risk, people will not stay in place. Have you thought at all about the role of migration as we start seeing these changes?
Mekala, would you like to?
Yeah, that's a great question. We looked at it a little bit, but didn't do a wholehearted analysis on it. I think there's a few different things to think about in the climate migration context. I think the first is that climate, when you think about the factors that drive migration, there's a multitude of factors that could influence migration. It's things like poverty levels, presence of strife, so on and so forth. And what our work finds or suggests is that climate is an added stressor. So in and of itself may not be the trigger, but combined with a variety of factors could drive migration. I think most of the literature to date suggests that a lot of the migration that we have seen to date could also see in the future may not be cross-border, but maybe more within border internal migration. So I think more work needs to be done to substantiate that, but I think that's where the academic consensus seems to be. I think what our work suggests, Jonathan alluded to it a little bit, is the migration in and of itself it could be thought of as a form of adaptation, right? So done in a planned way, what it allows you to do is to put people and assets out of harm's way and reduce exposure to risk. I think the challenge is when it's unplanned, when it's large scale catastrophic. And so what we have started to see, at least in some communities, is at least a starting conversation about how do we reduce our exposure to these risks? How do we think about ways to, for example, have homeowners participate in buyout programs to move their homes away from exposed areas, so on and so forth. So I think we need more of a conversation about how do we start to reduce our exposure to risks in a thoughtful manner.
Yeah. We have a question here from Jilam Sarkar. Can more gender equality induced measures improve adaptation at times of extreme climate events such as droughts and hurricanes, which are likely to become more common?
Yeah, sure. Happy to take that. I think, in some ways, this is part of the regressive conversation, right? So when we think about vulnerable populations being most exposed to climate risk, I think thinking about it from the lens of gender is also very important. I think that's for a few different reasons, right? So on the one hand, women often work in many developing countries in agriculture. In India, that's the largest employment share for women is in agriculture. So they tend to be in sectors that are most exposed to climate risk. They also tend to have lower incomes, lower level of savings. So their ability to be resilient in the form of in the face of climate risk is also limited. And I think then, so I think it's very important to apply a gender lens as we think about this form of risk in the same way as we've talked about the regressive characteristic more broadly. I think the other aspect of this is women's role as being part of the solution creation, right? So as we've seen in many different sectors, as we think about technological innovation, as we think about deployment of automation technologies, as we think about climate risk, it's very important that women as a stakeholder that is impacted by this form of risk, but also women as contributors to forms of innovation, to thinking about adaptation measures, to thinking about mitigation measures, need to have a voice at the table, not least because they could be among the most impacted, but also because they have the ability to contribute innovative thinking to the solution.
We have a question here from Robert Owen. To what extent do the different time horizons related to the pandemic as compared with climate change generate specific challenges for effective individual and collective responses?
Yeah, this is a good one. I think that, the pandemic response has created an unprecedented moment of innovation and productivity in a very specific area. So that energy is, if anything, encouraging in that it sort of demonstrates that when the conditions are there, that mobilization at pace and scale and productivity growth is far greater than we might have assumed. So it opens up that question of why isn't it like that all the time? And what is actually the limit on systemic innovation? So that's the first thought, is that, if we were to redefine or re-emphasize the nature of what is a crisis, that we might have more productivity in areas where we have been considering them, that the incremental learning, the learning curve or the pace of change is limited by some historic factor. So I might turn this around and sort of say, first of all, I think that the pandemic offers us an opportunity to rethink the pace of change and the pace of response. That said, we've also seen a great heterogeneity of response. and some systems having the capacity to respond collectively and others clearly not. So that, I think, is a measure more of the institution's capability of addressing the conflicts that are evidently standing in the way of that response. So I would argue finally that, as we raise, is a question that does the pandemic response itself have an implication for mitigation is something of an open question. I mean, I wouldn't rush to judgment, but I do think that there are some concerns that are justifiable that one should address around where we live, how much insurance we all want to buy, and what's going to be the economic equation for addressing mitigation, and particularly bearing in mind, again, equity-related concerns. In an era of mass layoffs and lower incomes, median incomes, those equity-related issues will be critical in any investment program going forward.
Thank you. We are out of time, and I wanted to thank you both for taking the time to do this with us. Jonathan, for staying up till 1 a.m. Shanghai time. It's nice that we can actually bring in people from all over the world. I know we have a lot of people from Asia also tuning in, so I do appreciate it. Thank you. This was a very comprehensive look at all the issues and exactly the kind of thinking that we need given the situation that we're in, just forward thinking and actually thinking in very practical terms of how we can start addressing the issues. So I want to thank you both, and thank everyone who tuned in as well. Next week, we are very pleased to be hosting INET's co-founder, Jim Balsillie, on digital transformation pre and post-COVID. So I hope you will join us for that. You can find the registration information on the INET website. So thank you all once again, and be sure to check out the MGI climate report. We shared the link, and you can also find it on the INET website. So thank you.